Welcome back to the What's Your More podcast. I'm your host, Quinton Harris, and I'm joined by my standing co-host, Daniel Halverson from Bank of England Mortgage here, back for part 2 of the April lending update at the beginning of May.
Yeah, you guys don't know this, but there's been about a 5-minute gap since the last time I was here. So.
Yeah, no, absolutely. So listen, if you're listening to us on just continuation, thanks for tuning in. You're back for episode 2. We're going to talk about 2 things here. We're going to talk a little bit about just some clarity from Fannie and Freddie as they touch on, we like to refer to them as the agencies, as they touch on their thoughts on the buyer-broker commission and weigh in on what they think could happen as far as does that or does that not count against the seller concessions. We're going to touch on that briefly here because there was a little bit of a headline that caused, I don't want to say some confusion, but I'm going to call it false hope. That's what I'm going to say it was. They threw something out there that has been the standard for so long, and yet we all knew what that was. They just threw it out there for everyone to see again. And then we're going to go into the rate debate. And, that's how we always finish up these lending updates here. So we'll kick it off. Agencies, Fannie and Freddie, also known as the Federal Housing Finance Agency, FHFA, came out and made some commentary. Dan, you want to kind of talk a little bit about it and what that meant for really the whole the buyer-broker commission stance and where that stands?
Yeah. We obviously won't get too far into the weeds on that part, but this is just a very simple clarification. So basically, NAR and the Mortgage Bankers Association sent a letter to FHA, Federal Housing Administration, and also Fannie Mae and Freddie Mac just to confirm if the seller paying buyer's agent commission would go towards the interested party contribution limits, meaning that if I'm paying a 3% commission to the buyer's agent and I'm paying 3% in closing cost, does that mean that I'm actually making a 6% concession instead of a 3% concession? And the ruling was that paying buyer agent commission does not count towards the interested party contributions, which is a very good thing. Essentially, all that means is that they still consider buyer agent commissions to have been historically customarily paid by the seller, and thus they don't count towards the financing concession limits.
Yeah, so basically they're just saying, hey, it's business as usual.
Correct.
Nothing's changed here, right?
That is correct, yes. So if you got a seller that's paying commission and they're also paying closing cost, only the closing costs are going to count towards that interested party contribution limit. Right. Unfortunately, VA has not provided any guidance on that. There are people lobbying for that information. Not me, but there are people out there lobbying for that information. And as soon as they make an announcement on that, I'm sure we'll hear about it. But this is good news for conventional and FHA loans to know that we're not concerned with buyer agent commissions counting towards how much a seller could pay towards closing costs.
I would be shocked if VA didn't follow the guidance of HUD, which FHA already came out and said. But let's talk a little bit about this here briefly. Why is this good? Well, because obviously the buyer can now buyer can get both, right? They can get seller to pay their commission to the broker, and then they can also to the buyer's agent, and they can also get the seller concession. So ultimately, that's a win-win, and there was fear those two would be mingled a little bit there. But I think this also kind of answers the call. What are lenders going to do? How are lenders going to help with this? And I think this is the best we possibly could have asked for, which was, hey, listen, if the seller agrees to pay that in the state in which you're working in, fantastic. And you're doing an FHA loan, you can still get 6% on top of that. Like, we're okay with that, right? That's good. That needed to happen. And I don't think we're necessarily in a market right now where people are just throwing 6% out there, but we're eventually going to get there. And if we didn't get clarity on this now, it could be, waiting for that to happen in a market in which we need it. So it's good to get that out of the way and, have a firm answer on that.
Well, and as a lender, you don't want a bunch of unsellable loans. So it's good to get that clarification to know that if that comes through and the contract specifies commissions and seller concessions, that, you don't have to worry about how do I approach this? Am I going to end up with a loan that the agencies won't buy? So it's good news all around.
Yeah, good news all around. And as we get more clarity on that, we'll continue to share that on here. But again, it's welcome news, I think, for the buyers and this new landscape of real estate that we're kind of entering in here. And I will say this about the new landscape. I think in about 6 months, this is going to be just business as usual. I think we're going to have it set in stone of how we want to operate and how things are going to look. And, I think there'll be a less, a less what if floating around, or the unknown. I think it'll be pretty known by that point. The clarity will come to the surface. So we're almost there. That's the good news. So, hey, here we are. The main event of the April lending update, of any lending update that matter. We're going to get into the rate debate, as I like to call it. But essentially what we're seeing is that rates have been squeezed a little bit. We had what we thought was the momentum to start bringing us down in those mid to lower 6s, and we were riding that wave, having a good time. But there's been some economic data that's come in that's put a squeeze on that. And more importantly, the Federal Reserve It's interesting because it's almost like I was talking to someone yesterday who has nothing to do with the mortgage business. It was a gentleman that worked over at the PGA, and we were conversing. He was like, "Hey, man, do you think the rates are going to come down?" I probably should have just showed him the sentiment from Fannie Mae that we talked about in the last episode. You know, pick your group you want to be a part of. But the reality is, it feels like the Federal Reserve is trying to get this there, and then all of a sudden you got these random members or voting members. It's almost like they want attention, so they just say something that sends everything into a spiral. And it's like, hey, look at me, I'm over here, and they just blurt out stuff that's completely irrelevant and doesn't go with anything Jerome Powell said. And it's this good cop bad cop situation. It's kind of getting annoying, but that combined with economic news, it didn't help rates, and here we are again, back to the starting point of really almost November of 23.
Yeah, I mean, to your point, part of the challenge is that the markets take information and they make assumptions and then course correct. A prime example is we obviously saw rates go down in December into January. It was great for business, right? Everybody was getting excited.
Right.
But part of that was the markets were projecting 6 rate cuts this year when the Fed said we're prepared to cut rates 3 times.
Yeah.
Right.
Talk about that for a minute, because we get asked this all the time. Guys, understand, if you're in the bond market, you're a bond investor or you're a trader, you're arbitrarily pricing in these cuts. You're coming up with that 6%. The Fed never said that.
Correct.
But the bond market and the people investing and the buyers and essentially the people that are trying to figure it out and price it in now so they can get the run up on it, they're the ones that came up with 6 rate cuts. That was never on a dot plot, Matt. That was never forecasted by the Federal Reserve. So when we didn't hit 6, you're kind of coming up short to this false expectation.
Well, I mean, part of that's, let's be honest, the big money that moves the market, right? They're trying to outperform the market, right?
So they have to get ahead of it.
So they have to make some assumptions or get creative because they're trying to beat what you could do if you just invested your money in the S&P index fund, right?
Right.
So that's part of it, But basically, it went from we're going to cut 6 times to we're going to cut 4.5 to we're going to cut 3. Now the markets are really, if you look at yields, just pricing in 2 rate cuts.
Yeah.
Doesn't mean the Feds have changed their stance. It's just saying the markets now are seeing this data coming in and saying, okay, well, we don't think we're even going to get 3 at this point.
Yeah. I mean, that CPI that came in earlier in the month. Now, we're doing this podcast on Wednesday, April, as I look at my watch, 24th, right? We're releasing in May. The challenge is that the PCE, the Fed's favorite form of inflation, drops on Friday, the 26th. So we'll get it then. But that CPI, essentially, the fact that it came in 0.1 higher, above expectation, but still has a stubborn 3 handle on it, that took a rate cut off the table.
Yeah, well, yeah. I mean, the headline number has gone from what I think 3 or 3.1 to now it's up to 3.5.
Yeah, and so the core's at 3.9.
Yeah, I think core's at 3.8. It was, we were hoping for it to go a tenth lower, but it didn't. Yeah. So the fact that the core rate is so much higher is troublesome to the markets because that's what the Feds think they have control over. And you can look at the inflation data and say, okay, well, we're still getting most of the increase here from owner's equivalent rent, from shelter costs, right? You could poke holes in that and say, well, is owner's equivalent rent the best data point to be using to determine if shelter costs are going up?
Sure.
You could argue. I mean, I would argue no, but I guess you could argue other points to that. If you look at actual apartment listing and renewal rents, those numbers are much lower than, if we were just using that data, inflation would be much lower.
Right.
So there's some things that aren't working in our favor there. But I think at the end of the day, the fact that inflation is not moving, and if you look at the readings from the previous year's months that are coming up here, you're not replacing high inflation readings with low inflation readings. So you start looking at the last leg of inflation and say, maybe it's going to take a little bit longer to get there, which I think anybody would probably reasonably expect that going from 9 to 3 is probably a lot easier than 3 to 2. The old sports analogy, going from bad to good is easy. Going from good to great is the hard part, right?
Yeah.
So this last little bit of inflation, go from 3 something to 2 is really going to take a lot longer than the Fed's probably anticipated or would like it to.
Yeah, and I'd like to make an argument here. Like, this is such an overreaction to CPI. Like the Federal Reserve, guys, the Federal Reserve doesn't even measure this. I mean, it doesn't look at it. It doesn't. I mean, that's easy for me to say because they stand up at a podium and they say our form that we measure inflation, our target inflation is going to be at 2 per target rate, and we're measuring at core PCE. That doesn't come out till Friday. Now, that currently has a 2% handle on it. It's like 2.8, something like that. It has a 2 handle on it, nonetheless. Has a 2. Here's a bold prediction. if the PCE comes in at expectations or maybe even below, because shelter doesn't make up as much of PCE, we may see a rate cut back on the table again. And we may see a windfall in those bonds because of this pseudo rally that could happen because, oh my gosh, wait a minute. The thing that the Federal Reserve actually looks at, that's still got a 2% handle on it. We're getting that much closer. I'm not saying that's what's going to happen, but it could. And if it does, that's a game changer. And I think you get that third rate cut back on the table, and all eyes are on Friday. Let's just call that what it is.
Well, I would argue yes and no to that. We kind of have this interesting dilemma where the Feds say we care about PCE, we don't care about CPI. Sorry if we're going acronym heavy here, but
yeah,
they're saying we only care about PCE. That's what we're looking at. The markets don't react at all to PCE. The markets only care what the CPI, Consumer Price Index inflation, is showing. So it's kind of this weird thing where the thing the Fed says that they care the most about, the markets don't care about, and then the Feds aren't as concerned with CPI, but then if the CPI comes in higher, we see this huge run on mortgage rates where if we get lower PCE data on Friday, I would probably argue that's not really going to impact the markets very much. So you're going to find out if the Fed is truthful or not in what they're monitoring. Mm-hmm. If you get core PCE to 2 and they start cutting rates, even though CPI is still somewhere over 3, I mean, you're going to find out if they really are going to make decisions based on PCE or not. So that'll be interesting to see if, you know.
There's always been this difference between CPI and core have never been on the same trend. They've never been on the same line. Matter of fact, there's always a gap between the two with CPI leading the way. So if you were to go back and look over the last, and maybe we should put a chart and put it on our YouTube channel so you guys can see it, what's your one more. But the difference is the CPI is always the higher of the two. It's always the higher of the two. And there's reasonings for that. Number one being the weighted average of essentially shelter costs, because housing is continuing to go up over such a long period of time. That's leading the way along with owner's equivalent rent. So I don't necessarily think that the CPI is what they're looking at because they know that's going to be higher. And by the time the CPI gets to anything with a 2 handle, there's a large chance the PCA can have a 1 handle on it. And that's problematic. That's where they don't want to be, because if you wait too long to get the result that you want, like you're trying to achieve at this 2.0, you may be actually doing more harm than good. And that's that whole analogy we've used of the faucet, putting it on hot water and then all of a sudden trying to go back to cold. It's extremes there. And that may be where they're putting themselves. And so there was a lot of commentary from the last Federal Reserve meeting, especially from Powell at the podium, that led me to believe you don't have to have the labor market crash for inflation to come down, and that they are fully anticipating to get into, basically get out of this restrictive territory. I mean, I do think it's coming, and I do think it's great that we're going to get the PCE on Friday right before the Fed meets the following week. So I think that that's crucial. I think all of that goes into the plan there. But, I think it's important to note that the markets, of all people, should know this, that the CPI is always higher than PCE, and there's not going to be a 2 handle on that before there's a 2 handle on the PCE. So it's kind of weird that they're even pricing that, they're anticipating it based on CPI. I agree with you. Markets move more on CPI, but it seems rather foolish. Seems like fool's gold in my opinion.
Yeah, no doubt.
So
yeah, I mean, I think the bigger news here is that the job market continues to show some resilience, right?
Absolutely.
And we I'm sure we'll have a detailed debate on that, but the reality is, I think if you're looking at what's going to happen first, the labor market gets a little bit worse or inflation gets to 2%, probably a situation where the labor market stands to maybe get a little worse before you see inflation at 2% on the dot.
Right.
So I think if you're looking for rate cuts this year, you're probably only going to find that if you see further softness in the labor market. And we've kind of turned a corner here where we're kind of getting the opposite of that recently, where in March, the Bureau of Labor Statistics job report, once again, they over 100,000 more job creations than expected in the business survey. And then for once, they mirrored one another, where ADP, which is private payrolls, showed 184,000 jobs, which was more than the 150,000 they were expecting. So you kind of have these job reports here were showing more strength in the labor market. And there's obviously some things that you could look at within the job report and say, okay, well, this is not as strong as it appears on the surface. But I think at the end of the day, you go back to markets move on the headline numbers, So if these job numbers keep beating expectations, it's probably not a situation where the Feds are going to be as eager to cut rates. But while we're on the topic, so, if you look at that job report from March, basically all of the job gains came from people that are aged 55 and up.
Okay.
Or basically under the age of 25.
Okay.
The prime age group for gainful employment is 25 to 54.
Yeah.
So those
meaning the people that are the big income earners.
correct. So those people are losing jobs.
Not good.
And those in the much younger or 55 and up category are the ones gaining jobs, which obviously we can just speculate here, but most of those, or a good portion of those, could be entry-level jobs or part-time jobs,
right?
Supplemental jobs. If you're 55 and up, maybe those are supplemental to, Social Security, other retirement income. So
right.
The fact that the jobs are coming from there is a little bit troublesome, but it also kind of mirrors the continuing trend that full-time jobs are being lost when you look at the household survey, and part-time jobs are being gained. So, but unfortunately, if you're looking at the job creations, if you lose your well-paying full-time job and you get a less well-paying part-time job, you still gained a job and lost a job. So the part-time jobs count as jobs all the same as a more lucrative job opportunity.
Yeah, an interesting thing on that job report, we kind of talked a little bit of this pre-show a couple of days ago here. Walk the audience through how they determine jobs created. Kind of explain how they come up with that, because it's not like, we know ADP's private payroll, right? So they can say these employers came up with this, but the BLS, how does the BLS come up with the jobs created with what they do? What's a simple way they do it? Just kind of break it down.
So there's a lot of modeling involved in that, but it's essentially a business survey where they're surveying businesses to get that information.
Yeah, so they're reaching out to businesses in the form of a survey, right? Some phone usually, right? And they're also reaching out to the people that are employed to let them know if they've lost their job. That's also how they do that, right? Phone calls. Have you taken a new job? You lost a job? And this is how that's done. So there's this notion, and we saw this in an article from Peter Bachvar, who essentially said, hey, here's the theology of what's throwing these job numbers off, because we've been talking about this for some time. There's a lot of illegal immigrants taking jobs in the United States. And there's a lot of people reporting, yeah, we hired some people, but you're not giving data on who you hired. You don't have to say I hired Charlie Walker and he's doing this. You just say I created a new job, right? You don't say who filled it. But yet the unemployment number is not quite reciprocating what the job creation number is. So there was this theology that there are some illegal immigrants that are taking up those jobs. They have to work, right? That's part of it. I'm not here to judge. I'm just saying it's a theology, and I thought it was pretty interesting. I hadn't heard that one yet. And it started to make a lot of sense. I was like, holy cow, that could be it. And then we look at this job loss sector, the unemployment numbers. We talked about this morning. This severance delay that's happening on the unemployment numbers. You've got Express filing for bankruptcy, shutting down 100 stores, right? 100 stores, that's a lot of employees, right? But they're all getting 6-month severance. And then you've got Nike that just laid off close to 800 people in their headquarters in Oregon. They're getting severance. We just saw where Microsoft did a layoff. Google's done additional layoffs. They're all getting severance. So those numbers are not showing up in these unemployment numbers yet either. And you made a point. You said, well, I guess we'll see them all in the numbers in January. 6 months, whatever it takes from now. But that's wild. And I guess where I'm going with that is if we can see that deterioration and also that distortion in the numbers, you got to think these guys can see it too. They got better tools than we do. You got to think they see that.
You'd think they have data we can't get our hands on. But the other interesting thing that I heard today, which was this was Barry Habib,
my man,
he's talking about initial jobless claims. Which if you're very surface level, the feds are watching initial jobless claims.
Finally said it.
If those start to go up considerably, they're more likely to cut rates faster, because that is obviously a early indicator that the job market's not doing great, right? More people filing for unemployment. But anyway, what Barry mentioned was, I think it was 4 of the last 5 or 5 of the last 6 weeks, the initial jobless claim number was the exact same number, 212,000.
Over and over again.
The only deviation was a shortened holiday week from Easter. Mm-hmm. But the point to that, or the reason they pointed that out, is you've got 160 plus million working Americans. And it seems unlikely that every single week there's the exact same number, and they round to the thousands, right? So, but there's not even 1,000 person variance in the jobless claims. So you question in continuing claims, been slowly rising, meaning people are staying on unemployment longer.
Yep.
But you would think if they're staying on unemployment longer, that would mean you would start to see more people in the claims data. So I'm not a conspiracy theorist by any means, but
Sounds like you are.
You start to look at that stuff and say, okay, well, something's not really adding up here. But I think that in a nutshell, if you're looking at how is the Fed going to cut rates 3 times this year, well, you're going to have to start to see jobless claims go up, the unemployment rate go up. If that thing starts to tick above 4.1%, you're going to start getting the attention of the Feds and saying, okay, well, we need to cut before the labor market gets worse, even though we're probably not going to get to 2% inflation anytime soon. Maybe we need to start cutting because we can't. If you're picking between a little bit more inflation and a bad job market, you're probably going to pick a little bit more inflation at the end of the day.
We talked about this. 17 of the 19 voting Fed members are highly concerned with unemployment numbers. And if that unemployment number goes up between 3.8 and 4.1, 17 of the 19 say we need to cut rates. Now, where are we at in unemployment right now?
I think we're at 3.8 now.
We're at 3.8 now, right? Yep. So we're inside that zone. We're on the edge of it on the concerning side. But if we creep in, if we creep into that 3.9, 4.0 territory, and unfortunately, we're not going to get any of those numbers going into. We're not going to get them, unfortunately. Job weeks is after the Federal Reserve meeting. And maybe they get a preliminary report. But the reality is this, it's going to be after the Fed meeting, right? It's going to be after the Fed meeting, and then you got 6 more weeks from that. But it'll be interesting. 212, 5 out of the last 6 weeks is not normal, right? And by no means are you saying, hey, those numbers are being, moogie-foogied anyway. But it is a little appalling that just you happen to land on that. I mean, it's like the roulette ball spinning around and hitting the same number 5 out of 6 times in there. It's possible, right? It's just not in your favor, but it's possible.
Yeah, I mean, what's more interesting to me is, if you look 12 months back, claims started to get in the 240s, 250s, 260s, and now we're back in the low 200,000s, despite the fact that rates are higher than they were then, and they've been higher for a much longer period of time. So It's just kind of an interesting development here that you're not seeing jobless claims go up, especially when you see the household survey of the job report. It's not encouraging data that you're getting. So not to say we want people to lose their jobs by any means. We want to do loans for people that have jobs.
I think what you're saying is we want accurate numbers.
We want accurate numbers.
We want accurate numbers, right?
And there's just some very conflicting data here that kind of makes you scratch your head and not really know what to think. But one other positive is, well, I say positive. One other positive for interest rates is that our average hourly earnings are continues to fall, meaning people are making less money. Even though they're making more money year over year, they're making more money at a slower rate, if that makes sense.
Right.
So, the Feds want to see people making more money to keep up with inflation, but they don't want people to be making too much money. Yeah. So if you start seeing the wage growth fall, that also bodes well for cutting rates because they get to a spot where they can say, okay, well, we feel like we can do this without triggering more inflation through more consumer spending.
Right. So, for all of our investors out there, this last comment is going to be for you about rates. As an investor, what's your goal, Dan? If you're a huge investor, you're a little investor. What's our main goal to get what?
Are you talking real estate investment or?
Let's talk about just investing in general. Doesn't matter what's our main goal is to get what you're trying to get a what on your investment.
Generate a return.
Yeah, you want a return. So we call that in the banking world. We call that yield, right? We're trying to get a yield. And so think about this. This is an argument to why higher might be better on the 10-year yield. Because the closer that 10-year yield gets to the short-term money market funds, the more investors are going to look at it and go, I know I got my short-term that changes basically day to day over here, and it's higher, but I could lock my money up for 10 years on this note backed by the full faith of the federal government at 4.7, 4.6 versus 5.25. I'm going to take a good portion and put it in there. And what that does for our audience is that as investors make their way into that bond note market, into the bond market, as they do that and they buy it, it's creating an appetite for the demand. And then all of a sudden the yields drop because you already have buyers. You don't need to sell anymore. So you drop the yield, which is good for mortgage interest rates. And we've seen that time over the last really 24 months. We're kind of at that moment right now where we're getting close to that trend line of the 5.25 of the money market funds. We might see more investors make their way. Now, remember, the biggest investor has left the market, right? The biggest investor is out there buying the 10-year note, right? And then the largest foreign participation that we get is not there either, which is Japan and China. They're not there. So 3 of our 4 biggest investors, not necessarily in that order, but 3 of our 4 biggest investors aren't even there. So once they start re-entering the market, that's going to be a game changer too. And that again doesn't take much to happen for mortgage rates to come down. I want to reiterate this. It doesn't take a Fed cut for mortgage rates to come down. That's where I'm going with that, because the rates are tied directly to the 10-year Treasury. So that's kind of the methodology behind our madness of, hey, we think rates can come down. So just wanted to share that with the audience.
Well, you're already seeing mortgage spreads get better than they have been, meaning the difference between the mortgage interest rate and the 10-year Treasury yield is getting lower. So it's been, if the 10 years at 4, mortgage rates have been at 7. Right now, 10 years, where is it? 4.6, 4.7?
4.64.
Mortgage rates are low 7s, so it's come down from 300 basis points to 250 basis points.
Because that would normally have been in the 8s last year.
Correct. Yeah. Very close to it. Yeah. So I mean, seeing mortgage spreads get better is kind of one of our arguments of why you could see mortgage rates come down even without Fed rate cuts.
Yeah, exactly. And that's our point there. So, all eyes are going to be on Friday on the PCE. You will be getting this podcast post the PCE. It'll already be out by the time you get this. And then also we'll be tuning in for the, Tuesday, Wednesday, the following week of the Federal Reserve Open Market Committee. And that ought to be a good one to hear what we say. I think everyone's at this point 99.9% sure we're going to get a pause again. Nothing more than that. But who knows? They could throw us a curveball, and we'll see what happens there. But we will be tuning in. You can guarantee we will have an episode of the Jerome Powell Show coming back from the podium, and Dan and I will be able to talk about that and analyze and debate PCE breakdown and what could happen. And I assure you guys that at one point we will be right. At one point, we will be right about the rates. We know it's going to happen. We just, at this point, don't know when. So we look forward to that and celebrating with you guys when that happens. And you can bet it'll be a flurry of business for all of us as it does. So, guys, if you like what you're hearing, please 5-star review this podcast on your favorite podcast platform. More importantly, leave us a comment. That's real important in our rankings. Help us get up there. And then if you would, go subscribe to our YouTube channel. All the graphs, all the links, all the data set points, we put those in there. And that's at What's Your One More with Number One, at What's Your One More with Number One. Dan, as always, thanks for all the wonderful insight, the great writing you put together here on the lending update, and all you bring to the table on our podcast here.
You got it, man.
Absolutely, guys. So the next time we will see you at the next episode of What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.